Stocks are falling and the big money index plummets to new lows in 2024. Hey, I'm Luke Downey. I'm with mapsignals.com going over our latest insights, and we're going to be covering a startling fact about the market. Most stocks are not participating in this rally. We've been talking about this a lot on this channel. In fact, I saw a stat this morning that was saying that the amount of stocks that are outperforming the S&P this year is the lowest on record. So if we look at this chart here, this is going to tell you a lot about what's going on in the market. So basically, I've got a chart of the S&P 500. This is a year-to-date chart, nice, beautiful uptrend. But here's the problem. When you go under the surface and you look at the number of stocks in the S&P that are above their 50-day moving average, that number is below 38%. So said another way, 62% of the stocks that are in the S&P 500, they are below their 50-day moving average, just as the market continues to make new highs. So what does that tell us? That tells us that breadth is weak, and that's exactly what we were saying multiple weeks ago, right? Breadth is weak. Now, before you start getting all bearish, you need to understand that narrow market leadership is actually bullish, not bearish. A lot of those pundits out there, they'll tell you the world is ending. If you study history, you know that that is not true. So here we are, we're looking at 1928 to 2023. So effectively 100 years of data. Here's what we do know. Whenever breadth is the lowest, right? And this is broken down into quartiles. The average 12-month forward return for the S&P 500 is a market-beating 15.4%. Whenever breadth is ultra high, you actually get lackluster forward performance versus history. Why is that? It's because when there's a lot of stocks on sale, there is value, and that means it's a great time to be loading the boat, which is what we're seeing right now. Here's what you need to know about the big money index. We've been showing some fabulous charts lately showing just how weak breadth is under the surface, and the BMI actually continues to fall. That's what this yellow line is, and we have just broken to a level of 42 and change, looks like 42.6%. So if we look at this on a 2-year basis, I've highlighted the prior 4 times whenever the BMI was falling below this 42 level, this 43% level, excuse me. Now, if you think this is end of days, you need to look at what the forward returns are, because this is where we start to tell you you need to be buying stocks right now. Here's the cool stat about when the BMI falls below 43%. So this is over the past 10 years, okay? The S&P, just so you guys know, on average, this is in blue, has an upward sloping return profile. So over a year, over the past 10 years, pick a day, the S&P tends to gain 11%, okay? Now, whenever the BMI is below 43, look how your forward expected returns continue to go up, right? 2.2% in a month, 5% in 3 months, and 15% in 12 months. Now, here is why we always tell you when the BMI gets oversold, this is one of the biggest bullish signals literally out there. You can ask a lot of our customers, they will tell you. And the reason is because when the BMI falls below 25, okay, that is in this level, this green line right here. See that? Boom, boom, boom. You can see what the market does. Here's what the forward returns are for the S&P. On a 1-month basis, up 7%, up 11% 3 months later, up 17% 6 months later, and up 27.6%. Holy moly, 12 months later. So what is the bottom line? The bottom line is there's a lot of stocks on sale. You've got record underperformance for markets. If you're not out there shopping for great deals, you are going to miss one of the biggest trades that is coming, and this is where Map Signals is there to help you. If you're a serious investor, if you are an RIA, make sure to subscribe to our Map Pro subscription. I will see you guys next time.